It's a common scenario. You have a credit card you haven't used in months, maybe even years, just taking up space. Your first instinct might be to cancel it, a simple, responsible act of financial housekeeping. However, that decision, which seems so straightforward, could have significant financial consequences, potentially costing you more on future loans. Before you make that call, it's essential to understand the two critical factors on your credit report that will be affected. The first and most immediate impact concerns your credit utilization ratio. This is simply the percentage of your total available credit that you are currently using. From a lender's perspective, a lower number is always better, with a general recommendation to stay below 30%. For example, imagine you have two credit cards, each with a $5,000 limit. Your total available credit is $10,000. If you have a combined balance of $2,000, your utilization is a healthy 20%. But if you close one of those cards, your total available credit is immediately cut in half, dropping to $5,000. While your balance is still $2,000, your utilization ratio has now doubled to 40%. Even without spending anything new, you appear riskier to lenders, and this change can lower your credit score as soon as the closure is reported. The second major effect is on the length of your credit history, a component that heavily influences your score. Lenders prefer to see a long and stable record of responsible credit management. Closing your oldest credit card could eventually lower the average age of your accounts, which can damage your score. Here is a critical detail. An account that you close in good standing does not disappear from your credit report immediately. It will typically remain for up to 10 years, continuing to age and contribute to your positive payment history during that time. The issue arises a decade later when that account is finally removed. If it was your oldest account, its disappearance can suddenly shorten your credit history's average age, leading to a potential score drop long after you've forgotten about the card. This does not mean you should never close a credit card. There are circumstances where it is the most logical course of action. The most common reason is a high annual fee. If you hold a premium card with a significant annual cost but no longer use its benefits, the fee becomes an unnecessary expense. In this situation, the cost likely outweighs any potential credit score advantage. Another valid reason is to manage spending habits. If a specific card presents a constant temptation that leads to accumulating debt, closing it can be a responsible step toward better financial health. Finally, closing an account is often necessary due to unfavorable terms, a high interest rate, or life changes such as a divorce that requires the separation of joint accounts. Before you proceed with canceling, consider these alternatives that can protect your credit score. First, contact the card issuer and request a product downgrade. It is often possible to switch from a card with an annual fee to a no-fee option from the same bank. This lets you keep the account open, thereby preserving both your credit limit and the account's age. Second, try to negotiate. If the annual fee is the primary issue, ask if it can be waived for a year. Many banks will provide a retention offer, such as statement credits or bonus rewards, to persuade you to remain a customer. Third, if the card has no annual fee, you can simply stop using it. To prevent the issuer from closing the account for inactivity, use it for a single, small, recurring payment like a streaming service and enable autopay. This keeps the account active and benefits your credit score at no cost. If you have considered the alternatives and still determined that cancellation is the best choice, follow these steps to do it properly. First, redeem all of your accumulated rewards as they are typically forfeited when the account is closed. Second, pay off the entire remaining balance. An account cannot be closed if it carries a balance. Third, call the customer service number on your card and confirm with an agent that you wish to close the account. It is good practice to note the date and the name of the representative you spoke with. Finally, check your credit reports from all three major bureaus a few weeks later to ensure the account is correctly listed as closed at consumer's request. So, does closing a credit card hurt your credit score? The answer is yes, it certainly can. It is not a minor financial adjustment. It is a strategic decision that impacts your credit utilization and the average age of your credit history. However, it is not always the wrong move, particularly if a card's costs outweigh its benefits or it encourages debt. The most important principle is to never close a card impulsively. Always weigh the alternatives first, such as a product downgrade or keeping the line of credit open with minimal use. Your credit score is a long-term asset. Manage it with thoughtful consideration.